Yes, I've linked to the original article below, but basically the interesting thing about the upcoming Fed meeting is you can really break it down into broadly four scenarios for outcomes. The first scenario is, does the Fed cut or not cut? Right now, the market's anticipating about a 90% chance of a Fed rate cut. And considering that the Fed really has gone out of their way not to disappoint markets in a major way, I would say that that's probably a reasonably good estimate. So that's scenario, that's outcome, binary outcome one. Binary outcome two is, do they give hawkish guidance or dovish guidance? Or I kind of more referred to it as, do they indicate that they're going to be cutting rates in the future, or do they not indicate that they're going to be cutting rates in the future? Those scenarios are much more of a coin flip. I've heard great arguments to both sides. I personally think that there's probably a greater chance, and I called it 60-40, that the Fed will not indicate that they're open to future rate cuts or use some sort of language of wait and see or pause or mid-cycle correction. Those would be the terms that I would look for. But that one, of course, is far less obvious than do we cut or not cut. But then, so if you have two binary outcomes that can coexist, cut, no cut, further ease, no further ease, that gives you four outcomes. 2 times 2 is 4. So you can basically, I put them in a box, and basically said, if you take a 10% outcome of no cut and a 40% chance of we're going to cut again in the future, that's a 4% chance of occurring. And then I attributed a move to it. And the moves that I put in the boxes were kind of guesses, and those are subject to change. And realistically, those were my best estimates at the time. Those are changing even as we speak. The best exercise would be for you to put in your own estimates of what you think the market might do under those circumstances. And basically, you can get a sense of whether the market is pricing in something bullish or bearish. I was sort of surprised because when I ran through each of the scenarios independently, I think the market's really priced in a lot of the Fed cut. So unless the Fed basically comes out, says they're cutting and are going to keep the monetary taps open, the monetary tap staying open is a good outcome for the equity markets. Although again, that even depends on how they say it. Are we keeping them open because the economy stinks, or are we keeping them open just to keep everybody happy? But I attributed that to be a high likelihood probability. 0.4 times 0.9, let's say 36% basically. And that had the highest likelihood of success. All the other ones, I think, basically could disappoint the market in some way. I think a rate cut, which is already priced in, and a Fed that's sounds basically like they're turning off the pumps for a while, could spook some people because I don't think that's fully priced into the market. And I think the unlikely chance that the Fed doesn't cut rates in either situation would be pretty negatively taken by the market. Although I do think that if they didn't cut rates and said that they were going to keep easing, market might have a reasonable response to that. Again, that's in the wording. But play around with those numbers. You put in your own probabilities. I couldn't link it as a spreadsheet, but it'll translate very easily if you make a spreadsheet. It didn't take me very long to do. And you can make your own decisions. That's really the point of this exercise, is figure out what might happen, give it your own best estimates, and trade accordingly. Thanks.